Welcome to the Blockchain VC, a podcast about crypto and the digital assets ecosystem. My name is Tomer Federman, and I'm the managing partner at Federman Capital. We invest in the most promising blockchain startups across the globe. I have more than 15 years of experience in tech, and before starting the fund, I was on the product side at Facebook, where I led product strategy and global growth of some of Facebook's major ad products. Previously, I also lived in Silicon Valley for a few years, where I attended Stanford Business School. You can find me on Twitter at Tomer Federman. Before we begin, please note that this podcast is for informational purposes only, and all the opinions expressed on this show, either by guests or me, do not reflect the opinions of Federman Capital. Nothing on the Blockchain VC podcast represents an investment or financial advice. Please do your own research. Also, if you like this episode of the Blockchain VC and want to help us bring more awareness to the space, I'd really appreciate it if you can rate, review, and subscribe to our podcast. This only takes a few seconds and helps us get the word out. Okay, let's do this. My guest today is James Roy Poulter, CEO of The Reserve. Hey James, really excited you joined today. Thanks for coming on.
No, thank you, Tomer, for having me. Pleasure to be here.
Cool. So maybe to kick things off, would love to kind of hear more about your background and, how you got into the space.
Sure. A bit of a strange journey. I guess actually I like to say that I'm a philosopher or at least a thinker at heart. So studied philosophy at university, but actually very much went to university to get a job. So worked at Accenture, EY and other places, even in my second year. Ended up taking the grad scheme at Ernst & Young, so became a chartered accountant and was spending my time sort of moving people, capital and companies around the world, sort of effectively playing a game of, I guess like arbitrage between, national and local rules with global organizations. It's a very unfair competition. Had a good little stint there at EY for a few years, then left and taught myself to code. Wanted to be in tech and just wanted to make sure I understood what was happening properly. Did that informally, kind of just teaching myself. I literally sort of like jetted off to like Istanbul for 2 months and then Beirut for 2 months and just sat around teaching myself.
Wow.
And then today, London's expensive, right? London's expensive. So,
right.
It's if you want to lower the burn rate and get away from people, and just have a place that you can just concentrate and get stuff done. I cleared out to.
Right.
I then actually took a program called this must be 6 years ago now. Like a General Assembly ran like a thing called Web Development Immersive. It's like a 12-week long, 80 hours a week learning to code. And I pretty much by day 6 had learned more than what I'd learned in the 6 months before that. I don't know how it is now, but back then that was probably the best money I'd ever spent in my life in terms of like development. And then I was just like working at startups, often for free. Just like getting experience working with different CTOs and other people alongside of me. And then I joined a venture firm called Playfair Capital. Right at the beginning of its kind of like creation, it was effectively the incorporation of an angel investor, kind of the GPs. He was just doing too many investments, and I was only there for not even a year, and I still saw about.
Was that back in London or?
Yeah, exactly. Yeah, that was in London. Yeah, back in London at Playfair Capital. It was Federico Perzier Baroli who was the sort of kind of founder of that. Then we kind of set up Warner Yard as well, if you've ever kind of gone by that. And actually one of the things we did really well as a firm was effectively create a bit like a WeWork, a small one, but just for investors. And so we had varying points, tens of early stage funds and investors that were all fighting for, or at least searching for, and actually fighting is the wrong word. They were cooperating and syndicating and co-investing alongside each other into early stage tech. So always pre-seed, seed deals. We were writing checks from $50,000 to $300,000 into round sizes of anything from those sizes to 1, 2, 3 million. And actually pretty aggressive, pretty young team. I got to learn loads of things from them, but also got to learn loads of stuff from the other people that were in that kind of like co-investing space. And it's definitely part of why my sort of particularly my London and European kind of venture network is quite strong. But yeah, so did a bunch of deals, saw a bunch of stuff. I'd come across crypto as a developer, kind of like before that anyway, but I hadn't really got it. I didn't spend any time thinking about it. But when I was in venture, that's sort of when it became sort of a daily thing that I was talking about daily. And there were other investors in that room, some that do choose to remain much more private, but that, were on it really hard, really early, and have done very, very well off the back of that. But I've been thinking about it every day kind of like since then.
Well, and when was that?
Yeah. So let me think. So it was 2014 that I was at Playfair. No, actually it was 2013. Sorry, 2013 that I was at Playfair Capital. Now, unfortunately, I don't have. I mean, so I think when 25, I can remember we were like looking at it, and I think it was like single digit dollars Bitcoin was still. So like between $1 and $10 when we were kind of first around it, and there were people in that room that took big tickets and done well. I sadly, you got to think my position, right? So I'm a venture fund trying to invest in the next wave of technology. I am a finance guy, and I have taught myself to code. And so you'd think that I should be in a pretty good position to make a good decision about betting on Bitcoin or something, right? And I'm sorry, I have no miracle story. I have no miracle story of sticking, even 100 quid in.
Oh no.
It was a bit different. I guess like I kind of would like, I'd saved a bit of cash whilst at Ernst & Young, and I'd put that sort of invested all that in myself being able to learn and do these kind of courses and stuff. And so like I didn't have much free cash, to be honest, to even do personal stuff at that point. So it was I think I probably would have been able to chip in a little bit of money, but I didn't have the free cash flow. So but I've been following it since then. So 2013, literally, it's been like a daily thing. I have to admit, I had a small excursion into food, and I ran a kind of a full stack food delivery business for just over 2 years, called Pronto. It's a very, very different story, but I guess the short version here was that in my I guess unhumble and still protecting my ego view, we built probably the best food delivery experience in the world, and that's because we controlled the food, controlled the delivery, controlled the technology end to end. We just couldn't get it capitalized at our Series A, and it's a long and a different story, but a lot of interesting lessons. I had the unfortunate experience of having to effectively fire 100 staff, top to bottom on our last day, and we but it was an incredible company, incredible experience.
Wow.
Maybe a slightly unnatural place for me to be, but then from the day that finished, and that was kind of like August 2016, I've been full-time back in this space, just full-time, and I've not literally done a thing since that company went down. And then again, this is turning into kind of a long story, but I guess like I was actually originally looking at raising capital for my own project in the space, so doing something like an early ICO, and I do still often wonder whether there was a path there that may have been the right one. But I was looking at creating actually infrastructure for government revenue collection. So looking at, could we create protocols or systems that could help automatically sort of like collect tax at kind of like a global level and try and solve some of those problems that I'd kind of seen, or at least some of those problems I'd been abusing at the beginning of my career, whilst at Ernst & Young. I created a deck for that back in, Q4 2016. But the shortest version here is I kept on being asked to help other people in the space. So whether that was, investors, be it venture firms or family offices, in kind of helping them understand what was actually happening in the market, and if things were sort of starting to bubble at this point, particularly through kind of like, again, I was full time from effectively Q3 2016, but from Q2 2017, things were starting to look bubbly, and it was kind of popping up on everyone's radars that maybe hadn't been following it for so long. And so effectively the Reserve became, I founded the Reserve, which became in the beginning an advisory firm. And the core of the work that we did over the first year was actually advising investors on what was happening in the market. And we spent an awful lot of time actually just trying to educate people to understand what was happening, to due diligence the assets that were being issued, to work out whether the assets captured the fundamental value that the projects, may have been capturing. We did that at quite a scale. I mean, we even ran about 150 events across 25 plus cities around the world. Again, all sort of, never people coming and paying to pitch at those things to make those work. That was all, again, focused on providing value to investors. And actually, we used to joke, we're going around like, we're not giving investment advice, let alone putting someone on stage. We're actually just sat there giving do not invest advice, because the vast majority of the stuff was absolute nonsense, right? And so, yeah, an advisory firm in the beginning. And
that's actually a very valuable element.
Yeah, and then that just kind of spiraled and I guess like snowballed into, I guess like what the reserve looks like a lot more now, which was, we started investing our own capital. And so we do now, write tickets ourselves at kind of the seed stage in this space. We then also, for the first time in kind of Q4 last year, we stepped more into the, kind of like helping out on the project side. And I guess there's two kind of roles we play with projects. There's one is that we help a lot on the, I think it's quite broad, and I don't even like the word, for example, tokenomics. But we try and get involved with the economics and the governance of projects that want to listen, and we also get involved in some of the kind of the business development efforts. And then actually, we are now regulated with the Financial Conduct Authority to manage and arrange deals and securities, and to also do some other things, which gives us flexibility in being able to support projects in ways like, for example, support them with their fundraising. And we did that for the first time with a project called Dusk in Q4 last year, which managed to raise just shy of $8.5 million as Ethereum, literally the days that Ethereum fell through $80 in December last year. So that was really good fun. But I mean, that's the shortest story of like how we've got to kind of like where we are now. And I guess that if you look at the reserve and you look at myself, like we genuinely care about our industry. Like I think that the work that we're doing and the technology that we're building is really, really important. I genuinely believe that we can create a better world that is run on this stuff, and not everything should be or could be or will be run on this stuff.
Right.
But systems of power, systems of money, systems of governance, systems that need trust will be run on these technologies, or at least the new versions of these technologies that we're funding now. And I think that, I mean, again, for me, I couldn't be doing anything else. I think it's awesome.
Right. That's probably one of the most interesting, diverse kind of backgrounds that I've heard of people in the industry. So you started as an accountant, then you moved to coding, then VC, then food delivery, then I guess back into more of the investment side of things on the advisory side, and kind of that's pretty diverse.
Yeah, if you excuse the food excursion, I think it all makes a lot of sense, and it seems very consistent for me. But that's where we are.
So you're both an accountant and a coder and a finance person.
Yeah, completely. And there's all sorts of interesting experiences actually. Like even with it's the one thing I bring for the food is that we also did an equity crowd fund, in the food business as well. And so it's interesting the learnings, from it's another topic maybe, but we could dive into it. Is that we think that we invented crowdfunding in like the last 2 years in this sector, but it's like Europe has had legislation to support equity crowdfunding for I think 8 years now, and you've had and you have companies like Seedrs and Crowdcube that have led a charge in that, and it's been happening for years. And I think like this is something that we were really vocal about, when in the ICO boom, that it's like this is not people that care about backing the next wave of technology. These are gamblers and normal people that have been fueled by greed and a hope of a quick buck. Because if you want to look at the class of people that really cared about backing innovative startups, they were already investing on Seedrs and Crowdcube. And don't get me wrong, I'm sure there was a new segment. Like there was a genuine new tranche of individual investors that were brought, that didn't realize you could do this before. But the vast majority of the activity was nonsense, which is why it was so quick to fall away, because it never was really about backing, doing providing venture type assets, exposure to that to kind of like everyday people. It really was never about that. And there isn't a single, or at least there are very, very few projects that can swear on their family's life and say that the reason that they conducted an ICO was because they wanted to support the crowd. It was greed on all sides of that market. So it was interesting to be involved in equity crowdfunding before this wave came along.
Yeah, I guess you were ahead of your time a bit in that respect. So kind of back to the reserve. So you do fundraising, right? Fundraising in that you kind of advise the companies that you work with on ways to structure and raise financing. What else? Like, how should we be thinking about the reserve and the portfolio of services that you offer?
Yeah, completely. So if I try and keep it simple, there's sort of two things that we do. The first is fairly simple, that we do write tickets into seed stage companies. It's very rare that we write them, and I can talk more about our investment thesis kind of like after I've done this. But one, we write tickets to the companies, and then two, we deploy small full-time teams to work in helping and support management teams execute particular things that matter. And that can be quite broad. And one of the things that can be is that we can provide, and myself, I will deploy alongside, the CEOs that we work with to help on a fundraise. And we are regulated to do that. And so it means that we can actually arrange and manage deals and talk with investors on behalf of a project. But it's much, much broader. Like, we get involved, to focus on that second part is that, that kind of crack team that comes in. We talk about the reserve being alliance, execution, and perspective in decentralized futures. And we think it honestly captures what we do unbelievably well. Alliance, because when we do actually work with someone, we commit fully. We will do absolutely everything that we can to the last, straw and the last dollar, to deliver on what, we led you to expect that we could. And then it's execution and perspective, and that one, we think about the space, and we do think the way that we think about things and the knowledge that we have and our market view, which tends to be effectively a combination of understanding the new with understanding how the old works, why it does. And it's that overlap in that Venn diagram where we think there's a lot of magic, and it's that perspective that we bring, but it's ultimately execution. We don't just advise. Actually, now we get our hands really, really, really dirty, particularly for European management teams on the fundraising side. We think there's use Dusk. Dusk is an unbelievable project, has an unbelievable management team, and there is some incredible technology kind of underneath there. Every team and every project has its weaknesses, and nothing is perfect. But these guys, they were able to help in a lot of ways. But if we look at some of the things we're helping on now, we help across from branding. We do a ton of kind of business development and partnership work, and that's typically all kind of zero fee stuff where it's just we're happy to work alongside these companies for no up kind of front cost on this stuff. And it maybe falls back to the investment thesis and actually the investing that we do, because I guess that we're writing, say, $100,000 tickets at seed stage. And I guess that I'd be interested to throw this back to you as well, Tomer. And I think we can see where our overlap here is. But it's we believe we believe in a future based on trust, and we believe in that still we have not built the very best technologies which are going to be running that decentralized future across Web3. And so for us, we're still very interested in the infrastructure layer that is going to support that world. We don't care, and we don't honestly even look at kind of the DApp level at this moment. We just don't think the technology is ready for the kind of real use cases that we would want to fund. And so we're looking at kind of lots of different layers in that kind of Web3 stack, and we are looking to invest into management teams, into companies that we think are exceptional and kind of hit all the very normal things that a venture fund would be looking for. And it's kind of funny because, again, I think we have similar views on that, and maybe the market doesn't look at things in quite the same way, right. But we could go into that perhaps. But we look at things the way a normal venture fund would, that would be investing traditionally, but then we layer on top of that. We look for projects that we, again, are in that niche, but also we think can benefit from the very particular network effects that we do think genuinely exist in this space, and that have value creation which is attached to that. So what I mean by that is that if there's a project which does genuinely kind of like do the rounds on Reddit and Twitter, and it goes from having a community of 100 to 10,000 people, that actually having that community of people which are generally interested in the space and do care about building that that Web3 decentralized world actually adds value to that. And a super basic example of that, it's like, okay, if you're a protocol and you need developers to be building things and working on your open source code, then like if you have things which are interesting to those people and you can benefit from the natural network effects which exist in this business, we think there's an opportunity for companies in this space to actually create sort of exaggerated venture returns. And so again, what I mean by that is I feel that if you're looking at a normal kind of like venture fund, you're typically deploying cash over a, say a 2-year period with an expectation that you'll liquidate those positions over the next, 8, maybe longer if you've got some unicorns that stay private for a while, right? And that's like a fairly long fund cycle, right? Just say 10 years. And I think that the bulk of the reward that comes for those investments happens in the kind of like the tail end of that 10-year holding period. I think what's interesting is that with our industry, depending on the instruments, I think there's an opportunity to have value creation happen faster. And just have an exaggerated return profile where actually you might be able to get something more similarly in 3 to 5 years as opposed to, say, 10 or more. I think that we're also kind of instrument neutral. So I guess that what we care about, and it goes back to the advice we used to give and the kind of through the events and for the advisory work, that we care about investing into an instrument that captures the value that the project is creating. So that means that we're flexible. That means that could be an equity instrument. And so, one example, we invested in, Radix DLT. I think we committed a year and a half ago in the seed rounds. Actually, that was a convertible, but it's an equity instrument. Whereas we're also happy to invest into tokens, and so something we did recently was a company called Pocket Network, and they're completely different instruments, but with how the project's designed and how they're delivering, we believe that the instrument kind of like captures value. And as long as there is no conflict in that value, and one of the things that we hate is where there's like an equity vehicle that is being funded by some original investors, 2 years ago, that is not on offer, and actually what's being offered now is tokens with no value, and maybe there is some value in the tokens, but there's a clash, and like even like the basis of like if you've got two entities, or maybe there's not two entities, there's different ways you can model this, but it's like you often see these hybrid structures, right, with kind of either like Delaware US corps, so it's less common in our industry because of the US kind of the fear of the US. But if you look in the UK or Europe, you would likely have like a UK company, and then you might have a foundation. And even if that foundation is Swiss, or that foundation is, for example, like a UK company limited by guarantee or a trust, like the people and the directors which are running those have fiduciary duties. They have like literally duties enshrined in law, which they have to perform. And if they're not performing those, then they can get in trouble, is the short version. And we see that there are structures and there are founders which are on both sides of these tables with complete conflicts of interests that aren't just theoretical, they're legal problems.
So on that point, kind of curious, James, would you only get involved in projects that you also are planning or already, I guess, are investing into, or would kind of the reserve also advise some companies where you don't necessarily invest into? I'm trying to kind of, is this a VC fund that's kind of like, I guess, on steroids and does a bunch of other, stuff on behalf of kind of the projects, you invest in, or it's not necessarily both?
Yeah. So I mean, good question, Tom. I think that, we like to think we're the most valuable money on the cap table. And so I think that actually when we talk internally, we're definitely not a hedge. We can tell you things we're not a hedge fund. We do not trade. We have no idea how to play the markets. We value invest over significant periods of time, right? But actually, I do think we take more of like a private equity approach. And I guess like, look, I'm a founder first. I am a founder and a CEO first, not an investor. And so I think we are always mindful, and we never want to get in the way and be a pain in the ass, kind of person on your cap table. But like, I think that we believe in, actually we see that we can add, substantial value. And I do honestly think that, And I hope over time, for sure, we will continue to prove that we're some of the most valuable money on the cap table. So, like, yes, look, we are maybe a VC on steroids is sort of the very right way to look at it. It's all our own money that we're deploying. It's kind of a little bit different as well. And typically, every person in the team is typically deploying their own personal cash as well as our own balance sheet into each project as well. So when we talk about alliance, we often have a lot of skin in the game, kind of with each project that we are working with, and so we really care and we really help. So I don't know exactly how you would classify us, but like I think that yes, we tend to do fewer things and care about them, care about them a lot more. And we're typically that we are. If you look at, we've been helping Radix out and a bunch of stuff right now, and those relationships take a long time to evolve. And I don't know how long you think you take on average, Tomer, from when you first meet a project or you first come across a project, like what do you think kind of like the average length of time it is or it will be between you meeting them and you actually writing them, the check out of your fund? Like how long do you think that's going to be?
Yeah, in our case, it's actually pretty quick. Usually we get a pretty good sense very quickly, whether this could be something that interests us and whether it's also kind of in line with our investment thesis. And if it is, we start doing our due diligence, right? I guess like a typical VC fund. But it sounds like it is a bit different than your model, which I think is like super interesting because you're merging the VC and kind of the added value in investing into companies. And obviously sounds like you're super aligned also. You're investing your own money, but you don't stop there and you kind of take it a step beyond, right? Which is, which is a very interesting model.
I think there's also like there's a lot of, I think you probably feel there's a lot of false information in our sector. There's a lot of bad practice, which is still replicated and people don't realize it's bad practice. Yeah. And I think what's really interesting that founders don't appreciate is like people like yourself and us, we get to see so many kind of like more instantiations of things happening. Like it's like particularly for us, we get to talk. We're fortunate to have relationships with investors, and we understand investor sentiment kind of from all across the world constantly, kind of like every day. And we're always wary of founders that are kind of like constantly on the road doing the conference circuit, right? It's like who's actually creating the value? Like are you actually building anything?
Yeah, totally.
Yeah, but if you're not doing that, you might not have the most up-to-date market knowledge. And again, just a lot of the practices are just unnecessary. I'll give and even like then like it's interesting with like because there's lots you can learn from the old world and traditional ways of doing things, right? That even we were doing at Playfair Capital, 6 years ago, whatever it was. But it's kind of interesting because then there's lots of things we can learn. For example, the importance of maybe investor directors. But there's other things which we do try and extrapolate. And so, for example, vesting of founders, and we try and bring it up. Like if you're looking at founders, they're typically vested in like yearly installments, or like if you have an employee stock option pool, they're typically vested, year by year, and you might give subsequent grants to it, right? And this has been because it's when you're vesting, you don't typically have liquidity. So like if there's a founder that's been working for 4 or 5 years and they vest 25% of their holdings or 20% of the holdings each year over that 5 years, they don't have an asset which is liquid. Like, seed, Series A, Series B companies' assets are like unbelievably illiquid, right? And those founders typically won't have an option to liquidate these things, even if it's unvested, to liquidate their holdings until the trade sale or the IPO when all the investors kind of exit in the future, right? But that's
right. So let's sorry to cut you off, James. So let's talk about that point for a second because that's really interesting, and I think we're very much aligned on a lot of things. I think here we might have slightly different thinking, right? I mean, in terms of governance, how teams kind of structure their cap table and I guess align incentives. And I know you also alluded to that earlier. I think you talked about kind of a model where potentially, investors get liquidity earlier than what we typically see in the venture model. So would love to kind of get your thoughts about what you view as the ideal model of governance in this new world of crypto and blockchain, and how do you How do you make sure that it's aligned between the different stakeholders, right? The founders, the investors, the people who, maybe retail investors who buy the utility tokens at some point. How do you think about that?
Yeah. I mean, there's a lot of pieces in all of that. Look, I care about things being aligned, and I don't believe. I believe that sadly people get corrupted, and so I believe in putting the right precautions and practices in place such that people are effectively forced to be good actors, even if they were always going to be good actors in the first place, right? And actually, it's a weird one. It's I haven't mentioned it at all yet, but actually, we've given away, we've pledged the whole of the reserve to charity as part of that. So like, as we keep generating, hopefully, a more impactful business and generate more wealth, actually, we can't be corrupted because we've already given that away. But that's a side thing there. So like, look, the number one thing I care about is that when investors or when founders and projects are taking money off people, that effectively there are four potential outcomes. They raise capital, and the project is a success, and the investor makes a return. This is a good outcome and acceptable. The project can also be a success, and the investor can make no return because they've issued an instrument which has no value. That is an unacceptable return and outcome and has to be avoided at all points. There is a project can fail and an investor can make money. I mean, this is, from my perspective, this is strange and irrational, but is okay. And a project can fail and the investor can also make no money. And that is also completely okay. Like, we are in a game and we're in a business of making risky investments, which, yes, there should be a high chance of failure, and we shouldn't be blaming people unnecessarily when that does happen. So the question is, how do you ensure those sort of outcomes occur? And I think that there's two maybe key things that I pick up on, which I don't think have happened enough of yet, that I think can help ensure that those are the outcomes which happen. And I'd say that the first is kind of investor directors, and the second is proper vesting of founder holdings of the projects. And so on the first one, I think this is less founders kind of like founder led, and more that there has been at least a less professional investors are in this space that have not been willing to kind of step up and take on the work. And they even actually ICOs were typically not led by an investor. The terms were not set by an investor as would happen traditionally, where that lead would typically also mandate that they took board seats and had a say in the governance of that project going forward. There was no one doing that. And so you had all these projects raise all this capital with no representation of investors kind of like on the board. And so you had founders that could do anything with that money or anything with that project. And the investors, they could listen to them and try and maybe make them feel good because, maybe sentiment mattered because of the market cap of those assets. But really, I just do not think that's good enough. And there's lots of things which matter, which happen in the background, which projects do not know, which is really important to have an experienced investor director step up and be on the board. And it's so basic, but I think it's something which has been missing from this space. And I think if it had been there, I think we'd have seen projects which, for example, were managing treasury better. Like, I do not believe any experienced board level, investor that had their time in the typical venture industry would have let any of these projects gamble and keep 100% of their treasury in crypto. Like, it just never would have been the case. We've been advocating for liquidation of crypto when you've raised capital for investors. Like, investors did not invest in you to be a hedge fund. They invested in you to go out there and deliver these milestones. Now, if you raised 10 times the capital that you needed to deliver those milestones, you should never have done that in the first place, and you should have limited your capital raise, more, raised a sensible amount of money. But yes, so I believe investor directors still need to step up and still need to do more, and we need to be forcing founders and projects to take proper representation on the board and to think about things and do better governance in a more traditional sense. And then the second thing is vesting, where there are so many CEOs and founders in this industry, which two sides of this. One, they start a project and then they get rich and then they leave and start another project and they don't stay the course. And again, if you're venture investors like you and I, a 2x or a 3x isn't enough. that's like not a good job done. Like, that's not like, let's all go home and do what it is. Like, that's like a failure, right? And it's like, no, you've done the first step. You need to now stay the course for the next 10 steps and turn that 2-3x into the 100x, right? And then you've done your job. And if you drop out in the way, it may be an unbelievable exit for a founder, but it's a lack of, it's just they've not. If you've taken investor money, you have a duty to those investors, and so I do not think founders should be allowed the liquidity until investors match their returns. And I think founders and investors should have more honest conversations. And I do think, again, as an investor community, we have to push collectively founders to tie themselves into these. Founders should not be getting rich and leaving and letting someone else do this stuff. And the second part of that is that the number of founders in this space that like run free projects or advisors on 10 and then also run a fund, it's insane. Like if you're building businesses which are changing the world, that requires a dedication and a focus. And maybe this is opinionated, and I'd love to hear your view, but like, I do not believe you can run 17 things successfully.
100%.
So,
no, 100%.
That's my general view.
Curious then, how do you, so specifically kind of on the liquidity, I think we kind of both agree, right? Like, founders shouldn't get rich before they deliver the certain return, and certainly if they've taken on outside capital. I guess, how do you prevent that from happening and at the same time provide liquidity earlier than typical venture model?
Good question. I think this is where the conversation becomes important, because it's like, I still believe you need venture size returns. And if those venture size returns come sooner because the project's achieved what it was setting out to achieve faster, then that's okay. I do think innovation is happening faster, anyway. I do also think, and this may not happen in our industry, but we will see, the first one-person company create $1 billion of value in under 12 months. The rate that you can create value is increasing in my view. And so I don't think they're kind of incongruous with each other. What matters is that founders are not able to leave projects rich before they have achieved the goals and returned the capital on the investors that they've taken, and that leaving a project halfway through with a 3x, like leaving a project, you should lose all your holdings. And maybe you'd have vested 25% or something 2 years in. That would be standard. Like if you are a good leaver, as we would, if you are a founder in a traditional venture-backed kind of firm, you are typically going to have you're either going to be a good leaver or a bad leaver. If you get fired by the board, you're a bad leaver and you lose all of your holdings. If you're a good leaver, then when you leave, you still lose all of your unvested holdings. And so, like, if you were put on a 5-year vesting schedule by your venture, by your investors, or in the new round, because again, every time you're taking on capital, you are taking on and you are making people give you money in return for a commitment to deliver a return on that over time, right? So 5 years is nothing, but it's like, if you quit 18 months in, 1 year is vested and you can walk away with your 18 months work and you have that 1 year under the belt. And if you're a good leaver, you lose all the rest of it, even as a good leaver. And I think so it's like a super basic thing. We need better vesting, where vesting is not just, we're vested over 5 years and we get it gradually. The vesting is like, if you are not fully dedicated to this project for the 5 years, you will lose your entire holdings, or at least the holdings on a curve, right? And so I think for me, it's like, if investors, and this all comes back to investors directors, like, if the investment agreements that these projects are getting funded around become more suited to their purpose, they will start including things like good or bad levers. And the fact that it's a token, or it doesn't matter. The token should just be seen as a digitization of a certain set of rights, right? And what we as investors need to ensure is that we're investing into instruments which have rights and rules that not only have value, but have protection. And actually, it's the protection which gives them value, whether it's voting rights or it's like investor consents, which means that we have to approve the $1 million purchase of the yacht. Like, these are basic things, but it's like, it comes back to these investment agreements and to, the contracting and when we exchange this money and we put this money into the projects, that it's done on the right terms. because I do think that there is no inherent conflict with potentially a faster return profile for venture investors, and there's no inherent conflict with there being a liquid assets and founders being locked up and held to account to execute on the promises they gave for these people giving millions of dollars to them.
Yeah. I think where I see sometimes, I hear you. I guess I see where I do see, and it sounds like we agree on that point, unless, correct me if I'm wrong. Where I do see sometimes, conflict of interest is where you have certain projects where, they structure basically the offering as a utility token, right? Whereby, let's say the investors invest over a 12 months period and, the founding team, like within 36 or 48 months period. But after that period, right, whether it's like, 3 or 4 years, the founders basically get all their utility tokens. And at that point, assuming it's liquid, right, they can sell it, make a nice profit, and the investors might not have seen the return that they have expected. But sounds like we agree that that's really not an ideal situation and shouldn't be the way to structure deals moving.
Yeah, so the nuance there, right? The nuance there, Tomer, is that if you just copy the existing kind of the traditional way of doing things and map it onto here, you can protect for the kind of the 4 or 5 years. But there's additional reality in the real world where it's like, okay, so you leave your firm 4 years in, but it takes another 6 years for the exit to actually happen, right? And in that 10-year life cycle of that company, and IPOs are at trade sales 10 years in. And so even though the founder left fully vested 4 years in, there's still 6 years where they don't get any liquidity and they don't get rich. So I think what's interesting is that the when you map that across to our world, actually they do leave 4 years in, they're fully vested, they can sell their stuff if the instrument is on the market. And I think that what I care about here, and I'm not sure it does it solves the whole problem though, Tim. But what I care about here is that utility tokens in 99.9% of these scenarios have no value. But if there is a utility token which has value and founders have that and it is liquid, then my view is that it should be effectively normally the only asset which is there, and it's the asset that the investors have invested into as well. And so the investors should have had, in my view, even earlier liquidity than the founder. So I'm not sure this is good enough. But in the very least, if the founder has liquidity, the investor should have had liquidity first. And there still seems to me there to be a challenge as well. I think where because maybe because of the nature of our industry and the fact that actually returns can be generated sooner than actually projects can reach kind of like fruition, that maybe we need to, again, this is about implementing longer vesting schedules for founders, potentially. It's difficult to make vesting schedules aligned to milestones. But I think that if the founders and the investors should be in the same instrument, and there should be no additional instrument that a founder has which allows them to get out of something that investors do not. I think there could still be an inherent problem there, which what we're saying doesn't quite solve. But difficult.
Yeah. I kind of tend to agree that probably we can find a way to improve the process, I guess, compared to the way it's been done for decades now. But I haven't seen really a model yet that solves that, right? Because I hear you on kind of the 6 years in and, to the IPO and all that. Problem is, right, as an investor, usually, you'd like to meet with the leadership team, right? And oftentimes, certainly if you're investing early stage, such as yourself, that is the key driver in making a decision, right? Like you think the CEO is brilliant, or you think the CTO is just, outstanding. If they can leave well before, I guess, an IPO or any other exit scenario, that could create some, in my mind, again, some misalignment between the investors and the founders.
No, I agree entirely. No, I agree. I mean, there's another one. I think you met these guys, but Key Foundation, the two founders, Reda and KK, were like the number one reason we got interested in that business in the beginning. It's like, and it's so to do with the founders, because at this early stage, you don't have much more.
Yeah,
you really do. And like
exactly.
Again, the Key's founders Exactly, unbelievable. Like, with Key, the founder has had multiple exits previously, and is very, very dedicated to this, and it's not about financial return to them. But like that, even that's potentially dangerous, right? Because you need to ensure that they need to be obligated, not beyond reason or beyond health, whatever it is. But they need to be obligated to do their duty to those investors they've taken money from. And so I agree with you completely. It comes down very much to the individual at this earlier stage stuff, and you back people that you believe can go and execute on these things. And so if they do, if they drop out 3 years in, I mean, put it this way, like I believe that all the things that we're backing are businesses that are going to deliver value beyond the next 3, beyond the next 5 years, right? We see that they have a path over the next 10, 25 years to be delivering value kind of like in the world. And I think like we're trying to, to work with those companies at that infrastructure level that we do think will be the winners in their category at what they do, or they might have to innovate or pivot and continue to improve on what they have, but they'll be the winners in their category, and that they'll be around as a cornerstone of that, of that Web3 decentralized future. And that is not a 3 or a 5 year journey. That is very much so a 25-year journey. And I hope, and I guess it's like when you're backing people that maybe they're not going to be there for 25 years, but I think that we are absolutely, expecting and hoping those key members of the team that you are investing in, to be there for the course of that journey. And that might not be 25 years, and I don't think we would expect that. But it's definitely to a point where the project has reached an absolute maturity, and and if there needs to be a handover, there's a coordinated handover which is done properly, and a succession plan put in place, and the reins are handed over properly. But I think it's if it happens 3 years in, it's because the management team was not the right management team to lead a company through a different stage of growth. And that happens, right, as well. You can back incredible people which you believe are excellent, and they are exceptional at getting something from 0 to 1, or from like pre-seed, seed through to Series A. But actually, the skills that you need, to run and lead businesses, whether that's CEO or CTO, from like a Series B through to like IPO stage company, are completely different. And then the skills that you need to run a public company, and that's another interesting conversation. The fact that we're creating public companies so soon in their journeys, but like is a whole different skill set as well. So there's a sad bit that maybe some entrepreneurs, aren't able to stand the course of that. But it seems to me that like if they are, if they're selling promises and they're taking the capital from from investors, they have a duty to do as they can, and to ensure. So it really is about the people. At the stage that we're involved, it's all about the people, which makes it even more important for us.
Yeah, makes perfect sense. So I guess last 2 questions, James. First of all, I feel like you have like a really good perspective on what's going on in the market, and certainly teams at the earliest stage, basically, where they're just figuring out their go-to-market plan and how they're going to get funded and so forth. You talked earlier about your investment thesis and your focus on infrastructure. How do we get to mass adoption of crypto, right? Like, how long do you think it's going to, are we really far from it? And also, like, what's holding us back? Like, when will we start seeing Bitcoin or any other cryptocurrency being widely used? Just curious to get your take on that.
Yeah. So I think there's 3 macro categories here. 4, maybe even. I'm making this up on the spot in a way. But Bitcoin is its own special entity, right? Bitcoin is, and I think Bitcoin should have its own way of valuing it, its own way of looking at it, will have its own independent future of the rest of the technology in the space that we're going to in. And I think it's an incredible achievement, Bitcoin, and I think it has a bright future. But park Bitcoin. I don't think you've I say that, and I've now even forgot. So what's going to get us to mass adoption, right? There's then a potential currency. There is a potential like Bitcoin. I do not believe will be a currency. I do believe it will continue to act more like a commodity and a store of value and a potential store of wealth. I do think it is like our digital gold. That's my view. I do think there is room for a desovereign currency, a global currency, which has basically, zero cost transactions, peer-to-peer transactions with no intermediary, instantaneous, globally. Like, I believe someone can create that, and I believe that that is this. But I think my personal view is there's one winner of that as well. I don't believe in kind of like a 100,000 currency kind of like version of the world, though. That there's more nuance to that, but in the interest of time, then I believe there's like tokenization of all these kind of like basic things like equity or normal stocks, just tokenization of normal things that have value. And then I think that there is kind of just all the other activity that's happening. And I think that like for category 3 of like tokenization of like normal assets, like people do not need to know that it's happening on Web3. And for most of like, if we're building, wallets that are dealing with crypto, etc. Again, I think largely that success is going to come when people do not realize that it's that it's crypto or whatever we call this space underneath the surface. They need unbelievable user experiences which just work and just deliver value to them, which is, ideally an order of magnitude better than the currently centralized version of this, right? And I think that until we're at that point, like, because Joe Public cannot be, and I don't think should be expected really, to care about what technology sends their US dollars from one side of the world to the other. I think we have to mask all of this, create unbelievable user experiences, and I think that when we've done that, that's when things will come through. But I think if we look at limiting factors, I do honestly think that there have been significant limiting factors and constraints just in the core technology. Like we spend a lot of our time also, with corporates, and I didn't talk much of it, but a lot of the beginning work of the Reserve as well was on the corporate side, and like we've not done paid work for them, but like Accenture and IBM are people that we talk with regularly, for example, and like there is so much. So many things which have been tried and tested around the world, which are actually held back by a scaling challenge, that actually anyone that's doing anything significant, or has an app which is used by a significant number of people, can't really put that on to anything in our space because stuff just breaks at any kind of sensible volume, or you're running it on a less than perfect kind of like network, right? And I'm not going to call out any names here, but I would say that most of the networks that are running at better scales have very, very, very significant centralization problems, to say the least. Yeah. Right? Like very, very significant centralization problems. So I think the scaling challenge needs to be solved. Again, it's another plug, but like we backed Radix a year and a half ago, and I've been working with Piers, the CEO, for 2 years because like we do think that they've built the best technology in the world, and it does solve that problem. It's the same with like with Pocket. We back Pocket because again we believe in a Web3, and it's like that for us is building companies in this space now is like, and this is another inhibitor and another constraint, right? Like if you want to build an app now, it's like building pets.com back in the early 2000s, where you spend so much time and money building servers and architecture, and then you get to build pets.com at the end of it. Right now, Amazon Web Services and other cloud providers and infrastructure providers came along to make it super easy such that you spin up some stuff and then you spend your entire time just building pets.com. Right now, we're having to do all the crap that was before AWS in the blockchain world.
Yeah,
and Pocket
it
for us
exist,
was,
right?
Well, so Pocket Network for us was something got involved because it's like an AWS layer for all the blockchains in our space. And like, okay, so this is talking about how things fit into our kind of thesis, but it's like these were real constraints for people building and using this stuff. And we have, and we are funding, those things. I mean, to round it off, I'll say it as well because it matters. Like again, we really, really believed in a decentralized stack, and we think that really all we've achieved as an industry, although I do think it's remarkable, what we've achieved over the last 10 and a half years is pretty much creating fairly centralized, plutocratic networks that run on AWS, which run on a centralized kind of like internet infrastructure. And I think that we've got so much to improve in all of that. And we are trying to tackle things at every layer. Radix at that protocol layer, kind of like Pocket, both at the kind of like helping protocols run full nodes and also with the app developers building on top of them. And even with Key Foundation, that's about, okay, if we really care about decentralization, just having properly decentralized networks running on top of our, the infrastructure which is controlled by governance is not good enough. And so we need to start funding entirely alternate internets, and and key is I don't know if you come across, but as a mesh network. So like we really care about Web3, and we do think that some of those things like scalability have been limiting factors for for real adoption, because there was a ton of people that I do think when it's proven that you can happily run millions of transactions reliably on a decentralized network kind of each day and that not be a problem, I think there is a queue of people that are actually there with use cases to put them on chain, but it's just got to come at the right cost and effort, and we're just not quite there yet.
Yeah. So last question, James, before we wrap up. Is there any kind of particular category, maybe even like within infrastructure, that you're most excited about? Just curious your take. A lot of people obviously over the past year have been very bullish about stablecoins, for instance, as a category. There's been a lot of talk about decentralized exchanges, not really materialized just yet, I think, in terms of usage, and TBD whether that's going to happen moving forward. Curious if there's any like one or maybe more categories in particular that you're excited about.
So I mean, I've spoken about why we did Key, Pocket, and Radix, and that was about what we believe is the best technology at the kind of the protocol layer, the kind of like the tooling layer, kind of around that to make it easier for things to build on, and then at like the core internet layer in kind of Key. So like, look, I think that I could say things like, for example, like stablecoins, we've not been kind of too interested yet. Like for us, that's almost like a DApp on top, and we still think that things are not kind of ready for that kind of like yet. For DEXs again, like not. I think DEXs are important, but I think I need to see better combinations of regulatory and compliance alongside kind of DEXs that are there. I'm trying to think, like, what do we think? I think like something that I'm hoping we get to work more on this year are kind of like some decentralized AML KYC kind of like networks or identity networks. I think that some of the players that have come so far are going to absolutely not best in class. So I do not think the winner is anywhere near there yet, but we've got some stuff in the pipeline that we think is really, really interesting, and I think that'd be super interesting. But I mean, look, I think that I don't think that Key Foundation, I think, is one of the most important and unique companies that we work with, and it's about creating a mesh network or a global, decentralized, completely redundant and robust to censorship, to shut down, alternate internet, right? And like, I think that it's not just going to be Key. I think there's going to be a number of players that like innovate and build out that robust and hopefully cooperate together to build out a safer, Web3 or a more reliable Web3 for everyone. And I think that's one of the most interesting things. And I think that hasn't even got started. Like, I really think that, and so that's super interesting as a space. And so I think that we will be focused on infrastructure for, the next few years. I think there's so much work to be still done kind of in that space at the deepest end of that infrastructure. Particularly, I think there's a long way to go, and there will be investment opportunities for and a lot of work, opportunities to do a lot of work for a long time to come.
Yeah, I completely agree. I mean, the space is just fascinating, right? And we're only getting started. There's so many opportunities moving forward for sure. Thanks so much for doing this. Really enjoyed the conversation. So really appreciate you coming on.
Yeah, thank you. Again, I think it's a good conversation. I think there's things that we've happened to cover there which are not spoken about enough. So yeah, pleasure to talk. Thank you for having me.
Thanks for listening. If you like this episode of The Blockchain VC and want to help us bring more awareness to the space, I'd really appreciate it if you can rate, review, and subscribe to our podcast. This only takes a few seconds and helps us get the word out.